What up, guys? So it's day 5, and today we're talking about Fibonacci. That's what we're talking about today. So without wasting much time, let's get right into the video. So on your trading view chart, we have this part where you have like a bunch of tools that you use to like do your markups on the chart. All right. So we're gonna come here. We're going to come here under Fibonacci. You're going to see we have a lot of tools under Fibonacci, but um the particular tool that we'll be making use of is the fib retracement tool. All right, so that's the one that has what we need, all right, for this class. Right now, under Fibonacci, we'll be talking about correction and continuations. Now for correction and continuation, I think I'm going to add impulse as well, because yeah, we mark it from the impulse. All right, hold on. So I'm going to come here. So let me just make it complete. Here we have impulse. All right, so under impulse, we're gonna have swing high, you know, to swing low, or just we can just put swing structures, right? But I'm gonna explain what all this means while I'm putting all this. All right, so listen. So we have Fibonacci, and I've said you go to the tool under Fibonacci session, you pick up your fib retracement tool, and that's what we'll be using. All right, now the fib retracement tool, you can customize it. If you put up the tool on your trading view, it's going to have like the default has a lot of settings that are just so complex. All right, you don't even, I'm not sure you're going to understand it if it's the first time you're seeing that tool, but I'm going to show you mine is customized, so you can, I'm going to pop out the settings. So if you want to make it look this way, then you can go ahead and do that, right? Let me just go to the settings. I have the 0 turned on, 0 0.3, 0 0.236, 0 0.61. Check here, everything is turned off, the trend line. So just look at, you can pause the video, copy these settings. Here we have levels. My levels is based on percentage, every other thing here. All right, we're not going to waste time on this. If you want to copy the settings, you can pause the video and copy the settings, and continue watching it again. All right, so let's go back to the class. Right now, we're going to start with the impulse, how we make use of Fibonacci. Right, so for the impulse, we will have swing high and swing low. Swing high and swing low, I'm just going to put swing structure, right? Because we can mark it either way. All right, and it depends on the trend. If it's for an uptrend, we mark from the swing low to the swing high. Then if we're marking the downtrend, we'll mark from the swing high to the swing low. Right now, we're going to start with an uptrend. Now for the impulse, all right, this is how we mark our fib tool. So let's say market makes an impulse this way. Remember, we said an impulse must break structure, and breaking structure, an impulse breaking structure confirms the low. The low that engineered that break of structure becomes our swing low, right? Now, this market is going to get to a certain level where it starts to reverse. All right, that reversal is for the correction. Now, once it shows us a signal for reversal, like that the market is about to start correcting, that means that is to tell us that the impulse is already over and we want to start the second phase of the movement, which is the correction. The first phase is the impulse, the second phase is the correction, and the third phase is the new impulse, which is also the continuation, right? Now, these are the three phases of the market that we're looking at. Now, the impulse is the one that breaks structure. The correction is the one that gives us the reversal signal here, indication that it wants to start correcting, then it start correcting. Now, to mark our fib tool, we usually take it for the impulse. All right, we mark it on the impulse. We take it from the swing low to the swing high. Now, if I want to mark this fib tool here, I'm going to take it from this way. The swing low, I'll put the first point at the swing low, then the second point, which is the 0% level. So I'm starting from the 100% level, which is the swing low, to the 0% level, which is the swing high. This is how I'm going to put it. Then I have all of these values. So I want you to pay attention to the 0%, 100%, and 50% level, right? So that's where the correction is going to come. Anything below 50% level is the discount. right? Is a discount. And in the market, if you're trading the market, you want to be buying at the discount and sell at premium, right? So anything above 50% is the premium price action, is the premium price, right? So you want to buy at discount. So when it's time to sell, let's say we are in a downtrend and market makes this kind of move, right? Let's say we'll have something like this. This is an impulse to the downside, right? So how are you going to mark your fib to? All right, you mark your fib to, you take the 100% level from the swing high to, and put the 0% level on the swing low where market has shown you indication that it wants to change character and start pulling back, right? Now if you check, we have 100%, 0%, and 50%, which is the middle line. Anything above this 50% level here is the premium, right? Is a premium price. And that's where you want to wait for price to come to before you start looking for opportunities to sell again. All right. And anything below is discount. So for a sell trade, you have to wait for price to come to premium before you sell, right? You have no business selling from discount. For a buy trade, you have to wait for price to what, come to discounts before you buy. You have no business buying at premium. You're only going to get stopped at when you buy at premium, because that is not the discount price to buy that particular asset, right? Now, this is for the impulse. We've talked about how you mark your fib to. You pick from the swing low to the swing high for, an uptrend for a bullish structure. Then for a bearish structure, you pick from the swing high to the swing low. And for the correction, let's talk about the correction now. um we've already talked about the premium and discount pricing, how the 50% separates the premium and discount. For buying, you have to wait for price to come to discount levels before you buy. Then for a bearish structure, you have to wait for price to come to the premium level before you sell. Now remember, if you've watched the video on key levels, so when I was talking about key level, I said in that video that if all right, if price gives us an impulse, all right, price gives us an impulse this way. All right, price gives us an impulse. If price is correcting, now we've got to the level where we start correcting. You don't know where price is going to stop and start the continuation. All right, or let's say you don't know, but there are specific areas where price stop and start the continuation, and those areas are what, key levels. So once price makes the impulse and start to show sign of correction, all you have to do is mark your key levels and wait for price to come to those areas. Then look out for change of character for continuation, right? Now, those key levels, if you want to buy, let's say in the case where price breaks structure to the upside, which is a bullish structure, and you're looking to buy, your key level has to be in the discount zone. Now, if you check the fib to, make sure once you've marked the fib to, let's say this is the impulse that we've gotten and market has started to correct. So if you want to mark your key level now that you want price to come to before you start looking for confirmations to continue the buying, your key level has to be below this 50% level, which means it can be around this 61.8, it can be around 78.6, it can be around 88.6, which is the extreme level. Are you getting it now? So it can be around this 88.6, any of these levels. So as long as the key level is within this discount zone for the case of a bullish structure, it is very, very valid. All right, it has a high probability of playing out. Now for the selling, for the bearish structure, same thing applies. All right, we're selling at premium. So if price is at discount, we ignore, because that is not the right zone to sell the market. So we're waiting for price to come to premium. And if we're to mark our key levels, it has to be key level sitting at the premium level of price, which is above this 50% level. So it can be 61, it can be 78, it can be 88, which is the extreme level that your key level will be sitting at. As long as it's above the 50% level, it is a very valid key level, and it is sitting at a premium zone. All right. So that is it. So for pullback, we've already established that when we have this market break structure and starts correction, we don't know where the correction is going to stop. So all we do is mark out key levels, right? So we wait for price to come to that key level, and we'll look for change of character or shift in structure to continue the buying, all right, which aligns with the what original trend. Now for the, we've already explained key levels, so if you've not watched the video, go watch it. Now all I'm saying is with Fibonacci, you have to make sure that your key level is sitting at discounts. When you mark from your swing low to your swing high on the impulse, this key level has to be any of this area. It's 8.6, 78.6, 61.6. As long as it's below the 50% level, it is the discount level and it is the value zone. So if your key level is sitting somewhere above 50%, it is low probability, and the chances that price will come, mitigate it, react a little bit, and invalidate it is very, very high. So you have to wait for price to correct and come to the discount level anywhere above below this 50% level, right? So that is that for the correction. Now for the continuation, I use this fib tool for my targets, all right? Especially when I get the trees, because I usually target 1 to 3 arrow. All right, I usually target 1 to 3 arrow minimum. So when I have trades that maybe at the 0% level, which is the technical target, is not up to that, I use my fib retracement tool to predict future targets, and I'm going to show you guys here. Now let's say we'll have something like this, same impulse and market break structure. All right, then we'll have our correction. Now this is my fib tool, right? Mark from the swing low to the swing high, right? So originally, all right, if we buy anywhere from here, which is the discount, we're supposed to target here, which is the 0% of that fib 2. This is the next structure point, because market is forming protected low and a weak high. So it's going in an uptrend, market is moving this way. All right. So you can see impulse, correction, impulse. All right, break structure. When we correct, if you want to make another impulse, it's always breaking the previous high. So on this structure now, if we have an impulse here that breaks structure, then we'll have a correction. If we buy here, this is the next, realistic targets, technical targets that we are supposed to target. This is the next point, next structure we are supposed to target for market to take out, because that's how. But sometimes you notice that when we break this target, market does not just do something like this. When it breaks, it comes back, breaks target. It does not just break this target and pulls back immediately. Sometimes it will do something like this. Impulse, give us that correction, then breaks targets and still keep moving up before it will correct again. So imagine breaking target and it moves all the way, like more than he moved previously. Like we've seen something like this where market breaks the previous structure and still keeps moving up. Then it gets to a certain point before it makes another big correction. All right. So that is what I'm saying. So instead of limiting your targets here, you can use fib levels, these fib levels, to even target higher points that are not structural level, but they are fib levels. All right. And those fib levels are two. There are two that I have on my fib tool. All right. The first one is a minus 27.86% fib level. All right. Majorly, I use the 0% level as my first target, which is the initial technical target. All right. Now, on the fib level, this minus 27.86% is my TP2. All right. My second target. And this last one, 61.80, is my third target, which is the last target, right? So these are probable areas that if market breaks structure, if it wants to continue, it will come to this level. These are areas that it will come to before it will show any sign of like reversal. There are fib levels that price tends to come to every time before it will start reversal. So the reason I said sometimes market just takes out the 0% and reverse. All right. But way back cases where it doesn't, it just breaks here and keeps going up, maybe it is very, very bullish. And so that is when we hit all of these targets. And that is the third thing I use my fib retracement tool for. Like I said, the continuation sometimes takes prints more candles, and yeah, that is how I make use of it. So I'm going to put this in a more clearer picture. We have something like this break, All right, we mark our fib too. Remember, this place has to show us that it wants to correct, all right, before we can determine the swing high. Then wait for price to pull back to discount, which is below this 50% level. Now we'll have to find the key level that price is going to react from. Then once price react, we'll find our change of character. Then this is our first target, all right. Then this is our second target, all right, and this is our last target. You can see out of these three targets, all right, out of these three targets, this is the only one that aligns with structure. All these ones are fib targets. Price might get there, price might not get there, but we use it. So I even use it in cases where maybe let's say I did not catch the trade here. All right, this is extreme because if I'm to catch the trade here, before it to get here, it will give me a minimum of 1:3. Let's say maybe it was a continuation trade. I caught it somewhere around there when price was already have the whole structure. All right, that getting to this point, it will just be like about 1:1 RR or something. So that's when I even push my target to somewhere like this. All right, so I can achieve that 1:3, or even somewhere like this to achieve the 1:3. Sometimes I can still take trade there and want to capitalize on the whole move. All right, so I would just like trim my stops. Once price crosses this level, I'll start trailing my stops, because once it crosses this 0% level, there's a high probability that it might just reverse anytime. So trailing your stops will just keep you, in the position, and once it wants to reverse, it can just take you out. Then that way you still make profit and you did not risk losing everything you've made, right? So let's go to the chart and see, few examples of this. So this is the good charts on the. Let's go to 1 hour time frame. Now on the 1 hour time frame, we're going to use this example. We have like this impulse, we have a correction, right? We have another impulse here that broke structure, right? And price put back. Now, if we want to mark our fib to, this is where I'm going to pick from here, that low to this high here, all right? So I'm going to pick, let me clean down, so I'll make it clean. My 0.0% level will be at the high where the correction started. Then my 100% level will be at the swing low, the protected level, right? Remember, this is where we have our break of structure, right? This is where we'll have our break of structure. Our break of structure. Now, look at where market reacted from. From that key level we talked about in the last class, you can see the key level is sitting at between the 78.6 and 88.6 level. That is where the key level is sitting at, right? So, and you can see market reacted from there. Where's our first target? If I'm to buy from here now, all right, putting my stops below the support level, my first target will be here, this 0.00% level, which is 1:3. If I want to target 1:5, I would have gotten it, which is, this is my first target, this is my second target. This first target is based off of structure, right? Based off of structure. The second target is a fib target. This is also a fib target. If I had targeted to the last point fib level, this price would have taken off. You can see as soon as we broke here, price did not just started correcting immediately. Price did not just correct immediately. We still went, you know, we still printed, more candles before the correction started. This is to tell you that market does not just, like we always, portray. Market does not just do something like this. We break structure, then correct. Then market break structure, something like this, then correct. No, although it happens like this sometimes, but there are really chart examples that will have something like this. Market break structure, correct. Then we'll break structure, then we'll keep doing something like this before we'll have another correction. So it can happen this way. Broke structure, impulse, correction, broke structure, then we'll have so the continuation always takes a longer time, right? So that's the case here. After we broke this 0.00% level, market still continue. You can see as soon as we hit that 61.8, percent level, you can see market corrected immediately, right? Market corrected immediately. Now look at another case scenario here, low and here. Now look at this. Price gave us an impulse here. This is where we broke structure, right? So these are our protected low. This is our weak high, and that is where the correction started. Now look at where market corrected to. We corrected to these points here. This is between the 61.8% level and 78.6% level. That was where market reacted from this support level here and started pushing up. You can see we took out this first target, which is the 0% level. All right, but market did not get to 27% level and this, all right, before it reversed heavily back down. So you can see in this case, if you're targeting these highs, it wouldn't have gotten there. So the logic behind using these fib levels as, you know, as your target points is not to just be so sure that, oh, price is going to get here. No. All right. So you just, like I said, I use them especially when, like, let's say this first target is not up to 3 hours. Let's say I got the markets from somewhere here, but if I had entered here before price will get here, this should be 1:3 already, right? Putting my stops here, this is even 1:4. But what if I got in somewhere around here? Let's say my stop being here and my take profit, this is 1:3. So I might want to get that this is 1:2. So I might want to get that 1:3, and that's why I will push it to this target. But I'm not just going to push it here blindly, because I know that there are chances that price will take out the 0% level and reverse. So I will trail my stops. All right. Trailing stops is, let's say your stop loss was there once price has moved. Since price has taken out this level, I'm going to move it to like break even. Then once price keeps breaking structure, I will keep putting my stops at the low of every structure that is created until price invalidates it. Let's see something like this. This is how you trade your stops. Let's say market keeps creating something like this. You keep putting your stops somewhere like this, because you know that the moment market does something, instead of creating this higher low, it does something like this and breaks it, it's going to take you out. And you know that this, for market to fail to create a new high, this is a failure swing, and this is also a shift in market structure. So instead of losing everything here that you've made, you're just going to get stopped at here, and as soon as price does that, you see everything just crumble. So that's all for this video. I hope you get the logic behind Fibonacci retracement tool. So I already like popped up the settings at the beginning of the video. So pause and you can change your settings, set yours like that, and make use of it. All right, I'll see you guys in the next video.